Did you know there's a way to earn consistent, reliable income while potentially slashing your tax bill? It's not a hidden trick or a loophole, but a time-tested investment strategy: tax-free municipal bond funds. These funds invest in projects that benefit communities, from roads and schools to hospitals. In this video, we'll break down the best funds out there, their specific advantages, and help you find the perfect fit to boost your income while minimizing your taxes. And when you're done watching this video, make sure to click the link in the description to check out Insider Newsletter. I've reviewed over 100 stock-picking services, and Insider Newsletter gets the best returns. And for a limited time, it's only $1 to try. A great place to start is with the iShares National Muni Bond ETF. This fund is a popular choice for investors because it offers broad exposure to the national municipal bond market. Think of it like a basket filled with a huge variety of municipal bonds issued by cities, states, and various local authorities across the United States. The main appeal of this fund comes down to tax advantages and a focus on reducing risk. First, the income you earn from it is generally exempt from federal income tax, making it especially attractive for investors in higher tax brackets seeking greater tax efficiency in their portfolios. Second, because the fund holds bonds from so many different issuers, it provides built-in diversification. This means if one particular city or state faces financial difficulties, the impact on the entire fund is lessened, making your overall investment more stable. This fund could be a particularly good fit for investors who want a reliable source of tax-free income, are comfortable with the moderate level of risk inherent in the bond market, and appreciate the stability that comes with broader diversification. Another excellent option is the Vanguard tax-exempt bond index fund Admiral Shares. This fund stands out because it aims to closely mirror the performance of a specific benchmark, the Standard & Poor's National AMT-Free Municipal Bond Index. In essence, it tries to produce returns similar to the broader investment-grade municipal bond market. There are a couple of reasons why someone might like this approach. First, Vanguard is known for its low-cost funds, and this one is no different. Lower fees mean more of your investment return stays in your pocket. Second, since it's an index fund, it follows a passive investment strategy. There's no active management team picking and choosing individual bonds, further contributing to lower costs and ensuring the fund mirrors its benchmark index. The Vanguard tax-exempt bond index fund Admiral Shares might be appealing if you're looking for a cost-effective and tax-efficient way to participate in the municipal bond market. It's great for investors seeking a hands-off, set-it-and-forget-it option that offers stability and long-term tax benefits. The iShares New York Muni Bond ETF takes a more focused approach compared to the other funds we've discussed. Instead of investing broadly in municipal bonds from all over the country, this fund zeroes in on bonds issued by the state of New York and its various local governments. This focus offers some unique benefits. For New York residents, the income generated from this fund is potentially exempt from both federal and New York state taxes, providing a significant tax advantage. Additionally, some investors like the idea that their money is directly supporting projects and developments within their home state, adding a feel-good factor to their investment choices. The iShares New York Muni Bond ETF might be a particularly smart choice for New York residents looking to maximize their tax savings while also wanting the potential to positively impact their own communities. The Invesco Floating Rate Municipal Income ETF is a bit different from the other funds we've discussed. Instead of focusing on traditional fixed-rate municipal bonds, this fund specifically invests in municipal bonds with floating interest rates. This means the interest payments on these bonds adjust periodically, moving in sync with short-term market interest rates. Why is this important? Well, when interest rates rise, traditional fixed-rate bonds can lose value. The Invesco Floating Rate Municipal Income ETF aims to reduce that risk because the interest payments on the bonds it holds will adjust upward as interest rates climb. This offers a potential layer of protection for your investment. Of course, like other municipal bond funds, it still provides the core benefit of tax-exempt income. This fund could be appealing to investors who want to maintain their exposure to tax-advantaged municipal bonds, but are concerned about how their portfolio will perform if interest rates rise. Let's explore the Vanguard High-Yield Tax-Exempt Fund Investor Shares. This fund stands out because it ventures into the higher-yield territory of the municipal bond market. As the name suggests, it focuses on municipal bonds that offer potentially higher interest payments. However, it's important to understand that this higher yield also comes with a higher level of risk. The bonds in this fund tend to be issued by entities with lower credit ratings, meaning there's a slightly greater chance that they may struggle to make their interest payments on time. This fund could be attractive for investors in high tax brackets who are willing to take on a bit more risk in exchange for the possibility of greater income. It's essential to be comfortable with the additional risk involved before investing in a high-yield fund like this, but the potential for higher tax-free income can make it worth considering for the right investor. And remember, if you want to make money with the stock market, make sure to click the link in the description to check out Insider Newsletter. I've reviewed over 100 stock-picking services, and Insider Newsletter gets the best returns. And for a limited time, it's only $1 to try.